This Chapter 1 summarizes the key features of a CDS contract, including the principal parties involved, the definition of a credit event, the calculation of payments before and after a credit event occurs, and a number of other important considerations. Summarizing the principal features of a standard single name CDS contract, i.e. one that relates to a single underlying entity rather than to a larger pool, should be easy in principle. The contract presumably needs to define who are the two parties to the transaction, typically known as the protection buyer and the protection seller, the entity to which the transaction is tied, the events that trigger the main payout, if any, under the contract, the means and different alternatives for executing this payout, and other principal terms such as tenor, frequency of payment, notional amount, and so on. Unfortunately, what appears to require a handful of pages of documentation at most turns out in fact to be some 125 pages long in the aggregate, which is one factor that makes this area of derivatives activity quite different from the others, in which a successful trader can trade billions based only on a very superficial understanding of the underlying documentation. The diagram about to appear in front of you describes the principal mechanics of a very common type of CDS. A protection buyer and a protection seller come together and enter into a 5-year swap on a $10 million notional amount, under which the buyer will make quarterly payments to the seller equal to 1% of the swap notional amount annualized, or $25,000 per quarter, assuming a 30-360-day convention is adopted. This 1% rate, which reflects the credit risk of the reference entity, but also some technical factors as we shall see, is normally referred to as the CDS spread, a term we will use throughout this discussion. The transaction is specifically tied to a third party whom we just a minute ago called the reference entity, whose credit condition will be monitored throughout the life of the swap. The contract defines certain events referred to as credit events, which have important consequences to the two parties. It has been typical in recent years to define credit event to include either a failure by the reference entity to meet any of its payment obligations under its outstanding debts, or a voluntary or involuntary bankruptcy filing by that reference entity. A credit event may or may not occur, of course, during the life of the transaction. The contract specifies that as long as no credit event occurs, the buyer makes the quarterly payments to the seller, and the transaction simply continues as before. If no credit event occurs during the entire 5-year life of the contract, the transaction terminates with the last quarterly payment. Note that just like an IRS or interest rate swap, there is no exchange of principal on the maturity date of the CDS. Now, suppose a credit event does occur. In most CDS contracts involving a single reference entity, as here, the contract gives the buyer the right to deliver to the seller a bond or loan issued or guaranteed by the reference entity, which is presumably trading at this point well below par, and in return to receive from the seller the par value of this instrument, i.e. $10 million in cash. Some contracts specify that the seller must pay only the par value of the bond, while others require the seller to cover also the bond accrued coupon since the most recent coupon date. There are typically a number of constraints imposed on the type of bond or loan that can be delivered by the buyer. These may relate to currency, maturity, governing law, level of seniority, whether the deliverable instrument needs to be secured or may be unsecured, and so on. The buyer is typically allowed to deliver any bond or loan that meets these constraints in order to maximize flexibility for the buyer and also to minimize the risk of a short squeeze if it is hard to find any particular bond or loan. To the extent the issuer has a variety of eligible bonds and loans trading at different prices, the buyer has an incentive to deliver the one that is trading at the lowest price. This optionality in favor of the buyer is referred to as the cheapest to deliver option and is reflected in the pricing of the CDS contract to some degree or other, with the CDS spread increasing the greater the delivery alternatives available to the buyer. Importantly, the great majority of contracts limit eligible deliverables to senior unsecured bonds or loans. Once a credit event has occurred and delivery of the permitted instrument has taken place, the CDS contract terminates, which means, of course, that no further quarterly payments will be required from the buyer to the seller. This process of delivering a bond or loan by the buyer and payment at par by the seller, possibly with accrued coupon, is usually referred to as the settlement of the CDS. Some contracts require the buyer to pay on the settlement date the CDS spread that has accrued since the most recent payment date, while others do not. This also affects CDS pricing, with those contracts that fall in the former category requiring a slightly lower compensation, i.e. spread, to the seller. We should mention two other important alternatives for how the contract sometimes settles when a credit event occurs. The first alternative involves what is known as cash settlement and has a parallel in other areas of derivatives. Under this alternative, no delivery of any security takes place. Instead, the calculation agent in the transaction solicits from the marketplace bid quotes for some obligation of the reference entity identified in the confirmation. The seller then delivers to the buyer per $1 of the transaction notional amount, an amount in cash equal to 1 minus RV, where RV is that obligation's price per dollar of face value, determined by the calculation agent from the bids he has obtained in the marketplace. In summary, this sounds simple enough and offers the convenience of avoiding some of the problems that have arisen when CDS notional amounts have far exceeded the total volume of eligible deliverables. But this presents other problems, such as the possibility that the parties who are asked to quote have a vested interest in skewing the price away from reality, and also what to do in cases where the prices obtained from different bidders are far apart, and what to do in cases of extreme market illiquidity when no prices at all can be obtained in the market. Our separate standalone module on the legal and regulatory aspects of CDS documentation addresses these matters in more detail. The second alternative that is sometimes used is to provide for a digital cash settlement following a credit event. Quite simply, this involves the stipulation in the confirmation of a fixed amount in currency that is payable by the seller to the buyer following a credit event. For example, 45% of the notional amount. Obvious advantages of this alternative include its simplicity and the absence of any concerns regarding the sufficiency of deliverables or the fair determination of market value post-credit event. Its principal drawbacks are that, first, it does not necessarily provide sufficient economic protection for a user looking to hedge an existing exposure to the reference entity, since the actual fall in value of that exposure post-credit event may exceed the amount the buyer collects under this digital settlement feature, which has in turn meant that regulators do not give digital settlement as much beneficial treatment for calculations of regulatory capital as they do with physical settlement or with settlement on a net cash basis. Returning to the physical settlement mode, you should easily have recognized the general economic consequences of the CDS settlement following a credit event: a gain for the buyer and a loss for the seller. The buyer has been able to deliver an instrument in default, or whose issuer or guarantor is in bankruptcy, to the seller for par. But this instrument presumably is trading at this moment in time far below par value, perhaps at 40 cents to the dollar. So in economic terms, the buyer has achieved a gain of $6 million. The seller, meanwhile, has paid out $10 million in return for taking delivery of an instrument worth $4 million only. So he has incurred a loss of $6 million, the flip side of the buyer's gain. We will see in later chapters that the buyer's gain may be offset, in fact, by a loss he has incurred on some underlying exposure to the reference entity, so that on a net basis he may have no gain at all, or at least a far smaller gain. And similarly for the seller, who may have shorted the reference entity on some other transaction, thereby offsetting to some degree or other the loss incurred under the CDS under consideration. But looking at the CDS on a standalone basis, there will inevitably be a significant gain for the buyer and a significant loss for the seller following a credit event. It is important to take a moment and understand how the precise wording of the CDS contract affects the economics of the transaction following a credit event. We have seen already that two clauses in particular may vary across different CDS contracts. First, the clause defining the exact amount of payment following delivery of a defaulted security to the protection seller, and specifically whether that payment covers or does not cover the accrued coupon in addition to the security's par value. And second, the clause specifying whether the CDS spread accrued up to the date of the credit event must be paid by the protection buyer. There are therefore four combinations of possible outcomes set out in the table you see here, which will shortly display the seller's net loss under each scenario. To add one simplification to our analysis, we assume that the reference entity has one deliverable bond only, whose coupon is C%. Thus, under all four scenarios, the seller takes delivery of this bond, representing a claim for 1 plus C per dollar face value, and thus whose fair market value at that point in time is R times 1 plus C, where R is the recovery value per dollar of claim. Now we examine the four alternatives in turn. In the top left quadrant of our table, the seller pays an amount equal to 1 plus C, while the buyer pays the accrued spread S in addition to delivering the bond whose value is R times 1 plus C, and therefore the seller's net loss is the difference between those two amounts as appears in that quadrant. In the bottom left quadrant, the seller again pays an amount equal to 1 plus C, while the buyer delivers the bond with value R times 1 plus C, but pays nothing else, hence this being the net loss to the seller. In the top right quadrant, the seller pays an amount equal just to $1, while the buyer pays the accrued spread S in addition to delivering the bond with value R times 1 plus C. So this becomes the net loss to the seller. And finally, in the bottom right quadrant, the seller pays an amount equal to 1, while the buyer delivers the bond with value R times 1 plus C, but pays nothing else. Note that the amounts indicated in this table do not take into account payments of the spread the seller has made previously, since they calculate only the net outcome of the cash flows occurring after a credit event. You might wonder which of these, if any, comes closest to replicating for the protection seller the result of assuming the reference entity's credit risk directly in the bond market, which of course would be implemented simply by purchasing the reference entity's bond. A perfect comparison is difficult, since the direct purchase of the bond would require us to factor into the analysis the investor's funding cost, which is uncertain and varies among investors. A useful simplification, however, would be to assume that the risk-free rate is 0 for all maturities, and also that the investor is a high-quality entity that can borrow at this risk-free rate of 0, more or less. In that case, the outcome becomes easy to visualize. The investor invests upfront $1 to purchase the bond, then finds himself holding that same bond but in default following a credit event, and the bond's value at that point would therefore be R times 1 plus C. The investor's net loss therefore would be 1 minus R times 1 plus C, which is the exact equivalent of the outcome in our table's bottom right quadrant. None of the other three scenarios in the table is guaranteed to produce an equivalent result to the simple purchase of the bond on day one, and even this isolated case is further complicated in reality by a number of distortions we have conveniently ignored. Specifically, the possibility that the bond is not trading on day one at par, the possibility that the reference entity has several deliverables which do not carry the same coupon nor trade at the same price following a credit event, and finally the reality, of course, that the investor does not borrow at the risk-free rate, nor that the risk-free rate is 0, either of which complicates the numerical analysis further. If you have time, you might see whether you can perform these calculations under each of these various alternatives. Just before we finish this discussion of contract mechanics and settlement issues, we need to mention one important feature that changes to an important degree the cash flow characteristics of a CDS contract for distressed reference entities. In the case of a distressed reference entity, the bond's market price begins, of course, to trade below par in most cases, whereas the payment from the seller continues to be exactly par following a credit event. This means, in effect, that the seller has more at risk than if he had simply purchased the bond to achieve a long exposure to the reference entity's credit. This reality typically drives the CDS spread some way above the bond spread over the risk-free rate, reflecting the greater contingent loss assumed in the CDS market by the protection seller. For reasons we will discuss in our module on the cash CDS basis, this upward adjustment to the CDS spread can never eliminate completely the mismatch we described a minute ago but it goes some way towards accomplishing this objective when the bond's price is not too far away from par. For reference entities that are severely distressed, however, the bond's market price often approaches 50% to 70% of par, or even lower, so that the adjustment of the CDS spread to reflect this greater risk for the protection seller becomes even less accurate in an attempt to eliminate the mismatch in risk. The worst case scenario for the protection seller would be to sign up for a CDS when the reference entity is trading at 70, say, happy with the knowledge that the CDS spread is some several hundred basis points and therefore compensates for the risk he is assuming, only to face a credit event shortly thereafter before having any chance of collecting much in the way of this fat spread. A different and special convention has therefore been adopted for severely distressed reference entities. These are normally defined to mean reference entities that trade in the CDS market at 900 or 1000 basis points annually or worse. In those cases, the spread is fixed at exactly 500 basis points annually, but the seller receives upfront an additional amount from the buyer, quoted in percentage points of the contract's par value. So, for example, the quote for a severely distressed reference entity might be 500 basis annually annually plus 37% upfront. Any further deterioration in the reference entity's credit would cause the upfront points to increase, and conversely, improvements in the credit would cause the upfront points to diminish. You should be able to recognize without difficulty that the receipt by the seller of the upfront points replicates to a large degree the cash flow consequences of purchasing the bond in the cash market at a significant discount from par, since the upfront points reduce the total amount potentially at loss for the seller. In the elegant scenario under which the bond is trading at 67, say, and the upfront points in the CDS market are exactly 37%, the risk of principal loss for the investor or protection seller become essentially the same. The return to the investor/protection seller, however, is still not the same under the two scenarios from a cash flow perspective, since under the CDS, the seller collects a fixed 500 basis points annually, while under the bond, he would be collecting normally a smaller spread over his funding cost, and then collects an additional large capital gain at maturity, assuming in both cases that no credit event occurs. The revaluation of CDS contract trading with upfront points becomes really easy. If I sell protection when the upfront points are 37%, and then I wish to unwind when the upfront points have dropped to, let's say, 32%, my gain would be 5% of notional. The fixed 500 basis points completely cancel out under the long and the short position. This completes Chapter 1.